This is going to be the single most important video a trader must watch to be successful in trading. I don't care if you're a veteran trader or a beginner trader, everyone uses candlesticks to trade. So for those of you that don't know who I am, my name is Nick and I'm a multi-six-figure prop firm funded trader. I don't have a paid course, I don't sell signals, I have absolutely nothing to sell you. In this video, I'll separate it into two main parts. Number one, what are candlesticks and where they originate from, as well as how to read them and use them. Number two, the candlestick patterns that all professional traders have in their trading arsenal and how to use them. I have used every single candlestick patterns in this video to get me to my multi-six-figure prop funded status, and I'm going to be giving all this to you for free. Before we start, don't forget to give this video a like and subscribe, as this will greatly help push the algorithm to reach out to other aspiring traders that wants to get started in forex. So let's get this video started right now. Before sharing with you the technicalities of a candlestick, I'm going to share with you where a candlestick originated from. So back in the day, way before our time, the markets have already existed, and how they would track prices then was by plotting every single transaction in the market by hand and by drawing lines to connect them so that they could see trends in the market. Obviously, this was tedious and inefficient. This made reading the charts easier and presenting information concisely to tell us where price is headed in that specific time frame. Now, what exactly are candlesticks? It is the most accurate representation of price over a specific period of time. Now, there are two main candlesticks. Number one, the bullish candlestick, and number two, the bearish candlestick. I think of it this way. It tells me a story of what price did during a specific time period. Let me explain. A candlestick is constructed using four parts: the open, the close, the low, and the high. Now, on the right, you can see a bullish candlestick, and here is how it forms. It starts off by opening price at a specific level. Price then comes down for a little bit and continues the rally up before dipping a little to close off the candle. During this period, it has created the lowest point in the candlestick and the highest point in the candlestick. The difference between the open and the low of the candlestick is called the lower wick. Lastly, the difference between the close and the high of a bullish candle is called the upper wick. Now, what defines a bullish candlestick is that the close of the candlestick must be above the open of the candlestick. The difference between the open and the close of the candlestick is called the candlestick body. Similarly, the bearish candle is defined when the candle is closed below the candle's opening. This has the opposite storyline as compared to a bullish candle. The candle opens at a specific price, goes up a little bit, creates a upper wick, proceeds to dump lower as seen over here, and pumps back up a little before closing the candle for that specific time frame. So we have the candle body here, which is the difference between the open and the close. The upper wick, which is the difference between the open and the high, and the lower wick, which is the difference between the closing price and the low created. Now that you understand how candlestick works, let's get into the juicy part of candlestick trading patterns. Let's go through the single candlestick pattern that I use the most first. The first candlestick pattern that I'll be going through is the doji pattern. They have a unique characteristic of the opening price being equal to or super near the closing price. Now, what does this mean? Let's use the storyline to explain this. Price opens over here, went up, went down, creating a high and a low before coming back to the opening price to close. The doji usually looks like a cross or a plus sign, so it's pretty easy to spot in the markets. This shows that the bulls and the bears are in a tug of war, undecided about where the market wants to go, and therefore this shows that it represents equality and indecision in the market, which usually means it's signaling a potential reversal soon. This candlestick pattern is especially strong when used together with a support or resistance level, as it acts as a confluence for you to look for trades. Now, the next candlestick pattern I'll be going through is the shooting star. A shooting star is a strong bearish reversal candle that has a small body with a long upper wick and no lower wick or short lower wick. This means that price tries to push up but fails to hold its momentum. The bears took over and pushed it down, resulting in the candle closing below the candle open. Therefore, this indicates a strong selling pressure in the market and potential bearish reversal might take place. This is especially strong when used with a resistance level as seen in the charts over here. The next candlestick that I'll be covering is called the hammer candlestick. Now, why is it called a hammer candlestick? Because it simply looks like a hammer. This is characterized by its small body with a long lower wick and no upper wick. Imagine the storyline again. The candle opened here, pushed down, couldn't close there as the bull stepped in and completely reversed this selling pressure, resulting in price closing above the opening price with no wick. This shows that the bullish pressure is stronger than the bearish pressure, therefore signaling a bullish trend reversal is imminent. This hammer pattern works exceptionally well out with a support level as a confluence to look for longs in the market. Now, let's move on to the double candlestick patterns. First, we have the engulfing candles. What are they? It's simply made out of two candles, with the second candle being larger than the first candle. Now, there are two specific types of engulfing candle. Number one, the bullish engulfing candle, and number two, the bearish engulfing candle. Now, let's look through the bullish engulfing candle first. For the bullish engulfing candle, the second candle must tower above or cover the entire of the first candle. This shows that the bullish pressure is a lot higher than the bearish pressure, thus engulfing it. It represents a strong bullish pressure in the market, indicating that a bullish reversal will take place soon, and this can be used as a confluence when buying at a support zone. Similarly, for the bearish candle, the second candle must eat the first candle, and it tells us that the bearish candle is way stronger than the bullish candle in the market, therefore engulfing the first bullish candle. It indicates that price wants to reverse to the downside. Therefore, you can use this with a resistance zone for a higher probability sells. Next up, we have the tweezer top. It is a key characteristic that both candles have super small top wicks or no top wick at all. The first candle must be a bullish candle and the second candle must be a bearish candle for it to be qualified as a tweezer top. This signifies that after two candles trying to break to the upside, it is unable to create a top wick, resulting in price coming back down in the second candle. This signifies bearish reversal in the market and is especially strong at the end of a bullish market or when the price has rallied for an extended period of time, as seen in this image over here. Similarly, we have a tweezer bottom. Its key characteristic is that both candles have super small lower wick or no lower wick at all. Same thing guys, the first candle must be bearish and the second candle must be bullish to qualify as a tweezer bottom. This double candlestick pattern signifies a bullish trend reversal is incoming and is especially strong at the end of a downtrend, as seen in this image over here. Now that we're done with the double candlestick pattern, I'm not done yet. So pay attention because I'll be going through the triple candlestick pattern. This will be the most important candlestick patterns that you'll be using because it provides the most information in the market to give you a bias whether you want to buy or sell. So if you haven't been listening intently, now is the time to take out your notebooks and start jotting down notes. First, we have the Morningstar candlestick pattern. It is formed using three candles. The first candle is a bearish candle, the second candle is a doji, and the third candle must be a bullish candle. Now, for it to qualify as a Morningstar, the third candle, which is the bullish candle, must close above the 50% of the first bearish candle. This shows that there is bullish pressure stepping into the market, signifying a potential reversal. This works best near a support level. So let's hop onto the charts to show you how to use it. Here we have a 4-hour chart on the Euro US dollar. Price here has hit a key level with multiple rejections as seen over here. And once it tapped again, as you can see in this example, price formed a Morningstar and proceeded to pump aggressively, indicating a bullish reversal is taking place. Next, we have the evening star candlestick pattern, the opposite of a morning star. The first candle is a bearish candle, second candle being a doji, and the third candle must be a bearish candle. Now, for it to qualify as an evening star, the third candle, which is the bearish candle, must close below the 50% of the first bullish candle. This shows that there is bearish pressure stepping into the markets, signifying a potential bearish reversal. This works best near a resistance level, so let's hop onto the charts to show you how to use it. Here we have a 4-hour chart on the GBP US dollar. Price here has hit a resistance level multiple times, and once it tapped into it again, you can see here in the example, price formed a shooting star and it proceeds to drop aggressively, which indicates a bearish reversal is taking place. Now that you have finally mastered the foundations of candlestick, many of you still have this question in your head: how do you use them in the market? So in order to do that, you need to be able to understand the purpose of a candlestick. They serve as a confirmation in your trading plan. Personally, I use them as my last confirmation factor before I enter a trade. I look at key levels such as support and resistance, order blocks, fair value gaps, and so on. Once that's done, only then I will look at candlesticks for the confirmation to pull the trigger. So remember, your support resistance, supply demand concepts are your base, and you add stuff like candlesticks to help you decide whether to take a trade or not. Now that you have mastered candlesticks and know how to use them in the markets along with support and resistance or your order blocks, I want to let you know that candlestick confirmations does not give you a 100% win rate. There are still times that you will lose with candlesticks. So please go ahead and backtest it on the markets so that you are able to be comfortable with it and add them into your trading plan. This is the end of the ultimate candlestick guide. If you have learned something from this video, do smash the like button down below and do remember to subscribe to keep updated with the videos that we are constantly producing for you. If not, that is all from me and I will see you in the next video.